All right, welcome back. We've spoken about facts and feelings a lot on this show, right? Some economic indicators are pure facts, and some are surveys about your feelings. And the fact is that the Fed and Jay Powell say they're going to still be vigilant on rates and inflation going forward. The feeling last week was that these hikes and hawkishness is that, well, that's over. And rate cuts are around the corner. Yay, yippee. The markets are saying that today, too. Bond yields imploded on the back of these feelings last week. The 10-year came down from, say, 5% to around 4.5%. And any way you cut it, that's a big move. Now, maybe the facts catch up to the feelings, but right now the feeling is rate cuts are on the way. Now, today we got more surveys on the consumer. The Michigan Consumer Sentiment Survey missed to the downside with a reading of 60.4% versus an expectation of 63.7%. Current conditions and expectations, well, they both also missed to the downside, as consumers also said that they saw inflation sticking around at higher for longer, too. I mean, that sounds like something else we've heard, right? My next guest does a lot of work on this in this area. Please welcome to the show a new guest, Craig Bolanos from the Wealth Management Group in Chicago. First-time caller. Thank you very much, Craig, for coming on. Love having you. You do a lot of radio with us. Appreciate you jumping on. All right, facts and feelings, rate cuts on the docket, maybe not. What are your thoughts here?
Well, I think feelings absolutely matter. And let's not focus on the numbers. Let's pay attention to the sentiment. And I don't want to understate the fact that there's a risk in this Michigan consumer sentiment data, which, mind you, it's only preliminary, Scott. But if we get to a point that people's expectations become unanchored from the data that we see, we could risk getting into a true price spiral. I mean, I don't think we live in Venezuela, but according to the survey, people are thinking that inflation's actually going to start trending higher, and that means consumers might not hold off on purchasing the washing machine. They might not hold off. They might start spending some of their money now instead of spending it later because they're fearful of a price hike. And if I can think of something the Fed absolutely doesn't want, it's exactly this.
Because then that will be a self-fulfilling prophecy for the Fed, and they'll be basically chasing their tail. Is that what I'm hearing from you?
We would be completely chasing our tail. I mean, no one wants to be in a price spiral. I mean, Scott, I live in the city of Chicago. We're already circling the drain. That's a whole other conversation. Right. But I certainly do not need consumers. I mean, where was oil in September in the 90s? Look at where wheat and corn prices were earlier this year. Scott, I talk all the time. I eat a hell of a lot of Doritos, so I know all about inflation. But the truth is, inflation's coming down. It's not going up. So to see consumers think the opposite right now, it's got me a little bit nervous, even though the market doesn't seem to care on a Friday.
Right, and yeah, this is a Friday market for sure. But you're referencing the fact that the consumers in that survey looked at inflation a year from now and looked at inflation 5 years from now, and in both of those surveys, they expected it to be higher than the expectation. So you're again kind of parroting what I think I hear the Fed say, that we're worried about having to keep rates higher for longer because of what might be happening with inflation. And that's exactly what the consumer is worried about, right?
Yeah, I mean, I remain in the higher camp. The Wealth Management Group remains in the higher for longer camp. But even though we're in the higher for longer camp, I don't want investors to think that it's a bad recipe out there. I mean, I know at the end of the day, there's two undeniable truths, and that is the longer interest rates stay high, the more difficult the economy is going to be, because the longer interest rates stay high, the more of a change we're going to see in consumer behavior. But sometimes the effect of that gets pushed off, not for days, weeks, or months. It can be literally pushed off for a year or two. So I think the soft landing is still probable. The hard landing is possible. And that's why I think people should be investing. And you know what? You're seeing evidence of that today.
All right. We talked about this on the radio show earlier this morning. Rate cuts. What are these guys smoking?
Well, you know what? I mean, pass it over to me. I think it might be some good stuff. I have a hard time believing, we're talking about rate cuts, but even when you look at a bar chart of some of the futures, I mean, what's the probability of a rate cut going into Q1 of next year? It's in the low teens, I think, at best, last time I looked on a Bloomberg terminal. So let's not mince words. I don't think it's happening, but if I'm the Fed, I'm continuing to talk tough because I want the market to do my work for me. And when the 10-year Treasury implodes from 5 down 50 basis points nearly, yeah, I get where he's coming from.
And so that 2% inflation target, could you ever see the Fed cutting rates before we got there?
Yes, because the 2% is just some myth that we are clinging to. It is a mythical number. I don't know how we get to a 2% print. I mean, don't get me wrong. I'm excited. Heck, we have a 2% print. I'm going to wear an outfit like you. I mean, it's going to be utterly fantastic.
Right.
You know, I got to find the frames, though. I don't know if I could find the frames to fill my face. Yours go perfect. You have a designer. But no, I just think it's not realistic. I think everybody knows that the benchmark's going to need to be higher than 2. This is not where we used to be. This is a new economy, a new world, and gas prices in particular are at the heart and soul. Because I'll give you one last talking point. When I break down this Michigan survey, I see it was young consumers and also those who are on the lower end of the spectrum that were the most concerned, and they were specifically citing oil prices leading into these inflation expectations. And how can you not be thinking about that with Hamas lobbing bombs and Hezbollah threatening to do the same thing?
Great first segment, man. Fantastic stuff. Love having you on. Definitely going to have you back, Craig. Craig Bolanos, he's the guy at the Wealth Management Group in Chicago. Thanks for being on, Craig. Definitely having you back. Great stuff. All right.